Well, happy Wednesday, everyone. We're chatting about the economic recovery and we're going through the January update today. My name is Kurt Mueller. Thanks for joining us. So to be clear and just to remind everybody as we look at this on a monthly basis, the three main components that we look at in terms of the economic recovery are macro-based indicators, economic-based indicators, and market-based indicators. So the data that we are analyzing, another thing I want to point out here, is actually November's data. So typically it's about 4 to 6 weeks behind. And I bring that up in today's video because we want to be clear about the fact that the lockdowns that took place in December as a result of the massive spike in COVID-19 cases, that effect on the data has really not been fully absorbed. So we really don't know what those lockdowns did or could do to this data in terms of the economic recovery, and we won't know until next month in February. So at any rate, as far as what we do analyze and take a look at is looking at just the key takeaway here, right? The bottom line here is that it's pretty apparent that the outlook for better economic growth and rising inflation is getting stronger. And again, that's based on the November data. So we're going to jump right into it. We're going to start with macro indicators. And the two components of the macro-based indicators are the 10-2 spread, which is the spread between the 10-year Treasury yield and the 2-year Treasury yield. And we also look at what's known as real interest rates. And so a warning sign would be that if we saw an outright inversion of that 10-2 spread and we saw positive real interest rates. Again, those two would serve as a warning. So what actually happened? Well, really, effectively the same thing that's happened the last couple of months. We saw a surge in inflation, which has caused expectations, or rather, which has caused the real interest rates to become even more negative. So it's effectively making the financial situation that we're in even more supportive, even more fertile for future economic growth and inflation. So here's an analogy that I want you to think about when we talk about real interest rates. So anytime we see a change in real interest rates, it's like pushing the accelerator or pushing the brake on a car, depending on what those real interest rates do. And right now, as negative as real interest rates are, it's almost as if the Fed literally has the accelerator all the way down to the metal, pedal to the metal. That's the best analogy I can think of here. And so I think it's reasonable to expect, based on that data, that we're going to see better growth and higher inflation in the coming months and quarters ahead. Now, that doesn't necessarily come without any negative consequences, and the negative consequences could absolutely be rising yields, which are going to put downward pressure on equities, but also it's going to increase interest rates. And so meaning we're going to see, it's likely we see an increase in mortgage rates, car loans, credit cards, etc. So that could put pressure at the consumer level as well going forward. All right, so again, that was the macro-based indicators. And again, we're looking at real interest rates and the 10-2 spread. Let's transition over to economic-based indicators. And there is a pretty long list of them, and so I will just read them off rapid fire. So stay with me. The components of the the economic indicators are light truck sales, 12-month total vehicle miles traveled, average work week, the number of jobless claims, building permits, and new orders for non-defense capital goods, excluding aircraft. Now, if we are looking at big picture on the economic indicator side, a warning sign would be if we saw multi-month declines in all of those various indicators I just mentioned. Now, what actually happened? Well, not a whole lot. Really, every indicator that I just mentioned, with the exception of jobless claims and the 12-month total vehicle miles traveled, every one of them, with the exception of those two, are back at pre-pandemic levels. So the data doesn't necessarily, again, the data does not reflect the lockdowns that happened in December. And that's why I mentioned that early in the video, that this is data from November. And so this data absolutely could change for the negative. It could go down next month when we are looking at December data. So assuming that we don't have any vaccine delays, then I think it's reasonable to expect that the economy is going to be back to pre-pandemic levels by mid-2021. But as I mentioned earlier in the video, that may have some unintended consequences. Namely, with rising yields, it's likely we're going to see rising interest rates, which are going to raise mortgage rates, car loan, credit cards, etc., which is going to put downward pressure at the consumer level. And rising yields will put downward pressure on equities. And so those could be some unintended consequences going forward. But again, I think it's reasonable to think, assuming we don't see any vaccine delays, that we will see the economy back to pre-pandemic levels by mid-2021. Okay, so we talked about macro indicators, we talked about economic indicators. Now we're going to chat about market-based indicators. And the two components when we talk about market-based indicators are Brent crude or oil and copper. Now, to be clear, a warning sign in those two, if we saw multi-month lows, that would indicate a warning sign to us. That would indicate that we are in perhaps we're coming in. Our economic recovery is slowing down or maybe even stalling. Right. So those are the warning signs we look for. Now, why do we analyze Brent crude and copper? We analyze that because those serve as leading economic indicators. Why? Typically, the reason why is because it has to do with manufacturing and industrial production. And so what actually happened with both oil and copper? Well, number one, we saw oil surge to above $50 a barrel, which we haven't seen since February, so pre-pandemic, February 2020. So that's a good thing. Second thing, as far as copper goes, we actually saw copper absolutely skyrocket to an 8-year high. And so I think if you look at those two factors, then I think they both reflect that we are having improving prospects in three main areas. Number one, we have improving prospects for better global growth. Number two, we have better prospects for U.S. growth. And three, higher inflation. I go back to higher inflation, right? So again, cautiously optimistic here. To be clear, I think some of the unintended consequences of this could be hyperinflation, so inflation rises too quickly. But I also think with those rising yields putting downward pressures on equities, it also is going to raise interest rates, namely mortgage rates, consumer loans, credit cards, car loans, etc., and that could put pressure on the consumer spending side. So, as I've echoed all along, I would simply say to have the mentality I would have if I'm watching this video is just be cautiously optimistic. I think that all things being equal, all signs point to us getting back to pre-pandemic levels by mid-2021. But this is 2021. And I think just like 2020, anything is possible here. And so I would maintain cautious optimism, but I also think it's time for you to really take ownership of your wealth building picture, of your financial plan, and actually fully understand what you're invested in, whether it's your small business, whether it's real estate, whether it's the stock market, or a combination of different things. Taking ownership of that, fully understanding how it's all working in unison to accomplish what's important to you, I think is really, really, really critical at a time like this. So as always, hope this is helpful and relevant. If you have questions, comments, please feel free to drop them below. And thanks for watching. Keep doing awesome things and keep dominating. Take care.